Peter Eliades with you. This is Stock Market Cycle's YouTube update for Wednesday, February 15th. We very seldom do YouTube updates this close together, but we're going to do this one because very little has changed from our last update, which was February 8th. The S&P today closed 0.7% higher. We gave you all the reasons for being bearish back there. This is where we did the update right here on this date right here. Follow the vertical line down. February 8th, right in here, okay? So we went down immediately a day or two, and now we've rallied back a little bit. So why am I doing an update? Several reasons. First of all, because of where the VIX index closed today. And secondly, because there's a turning point pattern. I would ask you to go back and watch my update recorded on November 30th of last year. It was right at the exact high. It occurred right here. That was the date of the update, exactly right here, okay? So, I've seen some commentary. I shouldn't even discuss the commentary. One of the comments that I will discuss, however, and something that is really aggravating, is I probably shouldn't react so greatly to it because there are always those out there that are going to criticize you. But this gentleman, after I spent half an hour going over the history of the VIX index pattern that I pointed out, that goes back for 23 years, some guy came on and said, VIX index is no good anymore. That's really a stretch to use the VIX index to try and pick out sell points in a bear market. I just got through showing how that, I don't know how many there were. There were more than 10 or 15 of them, maybe as many as 20, going back to the year 2000, showing every single time how it worked in a bear market. That's a very important qualification. This signal by the VIX index will not work at all in a bull market. So if you want to argue that we are now in a bull market, you can go right ahead and do that. And if you're right, this signal is not going to work. I think we're still in a bear market. And I think we're going to see that come to pass very quickly here within the next week or so, okay? So that having been said, take a look at the channel. We showed you this on the last update. You draw a line from the closing low on June 16th through the closing low on September 30th. You parallel that line. These are closes now, not bar chart. You parallel that line to the close, the high close on August 16th, okay? And this is what happened. So we almost hit three lows right here, okay? The low of June 16th, the low of September 30th, which is right here, the low close of October 12th, and the low close a day or two later on the 14th, almost got down to it. So it's at least 3 points that are virtually exactly on the lows trend line, paralleled up to the high in between, and we had verification of the trend line with 3 points here. We only did this. This was a self-appointed area here. We needed to get verification of the validity of this top parallel channel, and we got that. The close of February 2nd that came right up to it and turned around, at least so far. If it breaks above it big time here, you're talking a different story. I don't think that's going to happen. And let me show you why. We showed you this parallel channel in the last update a week ago. We did not recall for you, however, the pattern that we had in our November 30th update that talked about these red lines. Okay? 57 trading day turning point pattern. And look how it's worked over the last more than a year. This is the low in October of 21, straight up. Look at this spectacular rally. 57 Trading days later, on January 4th, right here, right at the all-time high, straight down. A big rally up again into the 57th day. This time it was 1 day off right here. There's the red line, there's the close. Huge decline, okay? The decline ended right here, June 16th, exactly where the next, either the 16th or the 17th, it might have been a day off, and then a huge rally. Now, this was not the 57th trading day. What happened was a quick move down and another move up, okay? And this one was 1 day off. 57th day was September 9th. The top came on September 12th. And in this case, another big decline immediately after the resolution of the 57 days. Then we had an excellent rally again. And guess where it stopped time-wise? You got it. Virtually exactly. This is where we did our update on November 30th. Virtually exactly on the 57th trading day. So where do we stand in the pattern now? Well, the 57th trading day is going to be, we got to be careful with this because I don't know if I calculated for the holiday next Monday. So we may be a day off on this. This is showing as February 23rd, but because of the holiday next Monday, it may be the 24th. But in any event, this is where how close we are to the resolution. So those are the red lines, 57 trading days, and it's been virtually perfect going back to this low in October of 21. This one right here, way up. This one here, way down. This one here, way down. This one here, way up. This one here, way down. This one here, I won't call it a way down, but a nice move to the downside right here. And now finally a rally up into what appears as if it'll be the 57th day is the red. Now, what I also did is put 3 of these 57 trading day patterns together and came up with a 171 trading day bottom to theoretically top count right here, okay? That one, I changed the resolution by 1 day. I started it on October 11th of 21. You go forward 171 trading days, you get the exact closing low on June 16th of 22. Okay? So here's your 171 trading days, bottom to bottom. And as George Lindsay, a past market master, always look for possible bottom to top counts. And that will take place a day before the resolution of the 57-day pattern. So we're right in this area. Let me zoom in here. They're 1 day apart, okay? This is the 171 trading day resolution, potential bottom, top. And that's on 221. But again, remember, there's going to be a holiday on the 20th, okay? This will actually be the 21st, the 22nd, and the 23rd, I think. Okay, the trade station has not yet allowed for the holiday, but this is how close we are. 1, 2, 3, 4, 4 to 5 days away, okay? Taking into consideration the holiday too. So, what's going to happen in that 4 or 5 days? I don't have magic to tell you. I have my projections, which are fabulous, but when you're this close to this trend line, and there's a chance that we penetrate this trend line. If we do, I think it'll be a false breakout and we'll immediately turn again to the downside. But this trend line, I'll tell you where it is currently. Tomorrow, on February 16th, it will be around 41.64. Then it comes down, it looks like maybe around 1.5 points a day. So by the time we get to this area, it's right around the 41.60 level, okay? So that's on a closing basis. That's one thing to be looking for, okay? Before we go to the VIX index, I would ask you, I try to be liberal with these free YouTube updates because, as most of you know, I do a paid subscriber update virtually every market day. If you're interested in that, We'll have information underneath the video to do that. If you're not interested, that's fine too, although this is the kind of information you'll get on a daily basis when you subscribe to our video service or get our software. Those are available, and again, the link will be underneath the video on YouTube, okay? I'd also ask you, if you're not a subscriber, to become a subscriber. And I'd ask you to kindly, if you get anything out of these updates, to kindly give a thumbs up. YouTube looks at those things, and it's nice to have a lot of thumbs up. And it's nice to have a lot of views. So refer this to your friends. And I appreciate comments too. I don't like nasty comments. I look at the critical ones and pay attention to them, and if I have an answer for them, I'll answer them. But if you have something to say, good or bad, I like the good ones. I don't like the bad ones. But listen, it's free out there, free to comment as best you can, as long as they're legitimate. I mean, if you're just going to diss what I'm doing because it's like the guy with the VIX index. Well, that's a real stretch to use the VIX index. You fool, you idiot. I just spent the half an hour showing you how it worked for the last 23 years, and you're telling me it's a stretch to use the VIX index? I mean, those are the kind of comments that drive you crazy. All right, where are we going next? We're going to the VIX index. And watch this. Here's the VIX index today. Okay, it came down and closed at 18.24. I have two horizontal lines here. They're arbitrary. I just based them on closing times when I did the research. This one is 1985. People ask, how did you figure out where to put the lines? And I said, it's arbitrary. It's arbitrary based on prior history, because when you see in the bear market, the VIX get this low, you better pay attention because you are at or very close to a market top, okay? And most likely a continuing move to the downside, sometimes a very sharp one based on the VIX index readings. What I did here was what I showed you in my last update. Once you get to these low levels, you draw in a trend line, you break a trend line to the upside, that gives you your signal. Well, we got the signal right here. We got a sell signal right on this date, okay? February 8th. Got a sell signal, okay? Based on the breaking of this trend line. But now we've immediately come back down again, not only below the first horizontal line, but just below the light green one here, which is set at 18.35, okay? You very seldom get to that level in a bear market. And what I'm going to show you, I hope relatively quickly, is all the times in the last 23 years where in a bear market you've closed at 1835 or lower on the VIX index. And by the way, here's another trend line here. These are the recent short-term highs in the VIX. You go back to this high, draw a trend line in, and a breaking of this trend line to the upside will be another sell signal for the market. Okay. Sometimes you get one, two, three of them in a row, but they're all in areas that should be close to market tops. Okay. All right. Let's take a look. Look at the light green line here. Okay. When did we close below it? Well, we did it today. Just barely, but we closed below it today. And then we closed below it on February 1st. Well, guess what? Follow the cursor down on February 1st and see where we were. That's correct. A day before this closing high. Okay. So we got close to it here. Being as honest as we can be, you got a signal down here that this was a low risk sell area in a bear market. And from that point, we've had a pretty good rally, okay? From this point right here, where we got down to 1835 right here on the VIX index, we've rallied 4.5%. That's in company with the largest rallies I have seen in a bear market after getting a reading this low. I'm going to go back and show you the ones going back for 23 years, hopefully relatively quickly, so you can see this is really unusual phenomenon right here. You don't usually see this kind of rally. because this is where the VIX index was on that day, and this is what it rallied to subsequent to that. Okay, let's go back in time. Follow the light green line here through the bear market, which began right here, okay? Where the dashed line is, that's where the bear market began. You had another reading right here below the light green line. That occurred exactly right here, okay? On the short side, the upside risk was 0 from here. And this is what happened after that. And that's the complete bear market. There have only been 2 closes below the light green line in the whole bear market of the last year and a month, maybe let's say 13 months, okay? And both of them were, well, we don't know the resolution on this one yet, but this was a perfect sell signal right here, okay? Let's go back to the 07-08 bear market. Here it is. Here's the light green line right here. We're looking for closes below 1835. We almost got it right here. Close was 1853. But look where the market was. Right here. Okay? Now, mind you, this date right here is where the all-time high occurred in October of 07. Okay? So that's the start of the bear market right here on the S&P. So we're looking for any readings below the green line after that. Well, you got one right here, right after the high occurred. And that was exactly right here at the secondary top. Yeah, you came close here. I don't think you got there. 1854 and 1850, okay? Very close, but look where you were. You were right here. Again, no upside potential at all. Another one where you're close here, you didn't quite get down to it. 1847, 1860, and 2026, these 3 days right here. Where did they occur? They occurred right here. Okay, this is what happened after that. Going forward, here's a whole group of them right here. This is almost like the current time zone. This happened in April to May of 08. So let's zoom in on this so you can get a better feel for it. Okay, we got down to the green line here, the light green, close of 1818. That qualifies right there. So here you go, right here. You could say that in and of itself was a sell signal. Usually we wait for a breaking of the trend line after you get down there, and that would have happened right here where the breaking of the trend line took place and the red arrow is. But you have 2 closes right around here and here. This one right here, right at this short-term top, you got a little bit higher than that a couple of weeks later, okay? Where else? Well, right here, just below the light green line, that happened right here. Now, this was a drawn-out period, okay? You had to wait for a week or two before you started really moving to the downside. But notice, there's no upside potential in this whole area here. I mean, when you got these 2 readings right here at the light green line, the market wasn't going anywhere. What, 1%, 1.5%, 2 maybe at the most from here to here? That's it. There was no looking for the beginning of another huge bull move, is what I'm saying. You get to these levels in a bear market and you're looking at a market top or very close to one, okay? Here's another one here. This was on May 22nd of 08. That occurred right here. And it held up. I mean, it came down sideways, up, sideways, whatever. And here's the last group right here, okay? 1814, 1783. Those 2 closes right here and here occurred right here and here. And again, you went sideways for 1, 2, 3, 4 days. And then this. And that's it. That's it for the whole bear market of 07-08. You saw every close below the green line. Okay, let's go back to the next bear market, working back. Okay, here you go. Arguably, the start of the bear market was right here, March 24th of 2000 on the S&P. It didn't go down for any length of time between that March and, let's say, September, when the New York Composite finally topped right around here somewhere. But let's look at all the readings that occurred right here after the all-time high in the S&P throughout the whole bear market. How many times did you close below the green? Well, there's a whole bunch of them right here, okay? This whole bunch of them. Look at this. See the red zone here? That virtually encompasses. In fact, it should be brought a little closer together. It doesn't go on that long. You had this period of August 14th to about September 1st, a period of a couple of weeks right in here with closes below the green. This is where you were in the market. Huge upside potential here, new bull market here. I don't think so, but a lot of people thought so at the time, okay? That's what that looked like. That was the first time since the start of the bear market right here, on March 24th of 2000. This is the first time you got below the light green line, and it was right in this topping zone. And then you didn't see it for a long, long time. You got down close to it here. No. You got down close to it, and then look at this right here. Okay? This is all within the confines of this bear market. Started in March of 2000 and ended with a double bottom in October of 02 to March of 03, a little bit off the screen there. But here you go for the only other closes below the light green line at 18.35. Let's do a zoom in again. Okay, here you go. Here's the first one right here. March 19th of 02. Look at that. That happened right at the top. Upside risk on a negative position, a short position, virtually zero. Look at this. It didn't start a dramatic decline yet, but that was the exact closing high in this bear market rally. Okay? The next time it happened, right here. March 22nd. That was right here. Never closed higher than that again in the remainder of the bear market. The next time you close beneath it, 1, 2, 3, these 3 days right here. 1, 2, 3. Never closed above it the rest of the bear market. The last couple of times occurred right here. April 10th of 02, perfect short-term top, and a top that you never exceeded for the rest of the bear market. The next time you close beneath it, one day on April 16th, right here, never closed higher for the rest of the bear market. One more time, the only other close below the light green line was right here, May 17th of 02, this exact short-term top before the resumption of the big downtrend, okay? And that's it, folks. That's every single close below this reading of 18.35. It shows 24 there, but this was set for 18.35 in a bear market. Anytime you had a close on the VIX index below that level, I have just shown you every single close below 18.35 in the last 23 years of 3 bear markets. 2000 to 2003, March of 03, 2007 to 2009, and January of 2022 to XXX, wherever this market bottoms. Okay? Okay. I want to show you one more thing. Let's look one more time again where we are in terms of current VIX index. So you know how important these closes are. You've seen them in action for 23 years in a bear market. Okay? I've been talking about this till I'm blue in the face. I did it on the last update I showed, but we hadn't gotten this low. We closed at 18.23 today. That's below the light green line, and that's very, very rare in a bear market. And let me emphasize the in a bear market phrase. If you see readings like this in a bull market and you think that they're going to mark a market top, you're dreaming. This will not work in a bull market. This is a bear market tool. Be aware of that, okay? So the only other argument you can make here is, well, maybe we're in a bull market again. Well, I doubt that very much, but I don't have the time to go into all my reasons why I say that, okay? This is still a bear market in my book, and these readings that you're seeing down here are marking a top in a bear market. Let me show you one more technical indicator that I think I've shown fairly recently. Remember this little baby? Fear and Greed Index. This is by CNN Business, and it shows the Fear and Greed Index. Typically, a reading at 75 is in the greed area. You see here where it says extreme greed. This is this line going across at 75. So above 75 is extreme greed. I forget where the cutoff line is for, let's see, I can tell you. Neutral greed. Greed begins probably around the 59, 60 level. Extreme greed begins at, well, we've just seen it. On February 2nd, that's when the high was made so far. February 2nd, 79 reading. Extreme greed. Okay? And then a couple of days later, with a secondary high in the market on February 7th, extreme greed. Today's reading, greed. Notice how these other readings, notice where they occurred. This one was at the March 29th high, a couple of days later in early April. This one was at the August 16th high, almost exactly on it. These occurred, well, November 30th was the high. Remember, we did the update then, right here, okay? So all these highs in the Fear Greed Index were highs in the market. Is this going to be another? The most extreme readings in the last year? We're going to know soon enough. And that's my update. Some of this is indeed repetitive from the last update, but because the VIX index got so low, 18.24, within the confines of a bear market, I wanted to let you know exactly what has happened in the last 23 years when you're in a bear market with a reading that low. And you've seen them all. That's it. So what do you do? Well, I don't give recommendations, but I will show you this. This is a beautiful channel. So if you're in a short position or about to take a short position, I will give two recommendations, and one of them is not to go short, okay? I'm not giving that recommendation. But if you have a mind to do that, this is a great stop area right here. I'd say any close 1% or more above this trend line, top parallel channel line right here, then you can exit your short position and say, hey, there's something else going on. Maybe it's not going to work out, okay? So that's point number one. Point number two is if you want to wait to get some kind of confirmation that a down move has begun, then you do what we talked about last time with these trend lines. The current trend line with this last move is right here. From the high back in October when the market reached the low to this little short-term high in the VIX index that we saw on February 9th, 10th, and 13th. Perfect little trend line right here. When you close above that trend line, there's your sell signal, okay? If you want to wait for it to be activated. You already got one here, okay? This was a sell signal right here. And believe me, I feel strongly it's going to pay off, okay? Where are we? Well, we're just about where we were when the sell signal was given. But the next action signal, the next sell signal, will be given with a break of this trend line, okay? Tomorrow, that trend line is around, let's say 1990. So a close above 20 in the VIX, anytime over the next several days, a close above 20 would get you above the trend line, and that would be an action trigger for those of you that are interested in taking short positions. If you want to be conservative, that's the conservative way to play it. Because you may get a further rally here, okay? And the VIX might go even lower. So that's it. See how easy it is? The market is not easy, folks. Market analysis is not easy. I know there are a lot of you out there that are professionals and thinking, this, and there's a lot of things you might want to criticize. All I did was show you what has happened in the last 23 years. It should strike you as being vitally important to the future of the market. And with that, I'll lay it at rest. Please leave me your comments. Leave me a thumbs up. Favorable things are nice for me. I like it because I work very, very hard putting these things together. Thank you very much for watching, and I'll probably talk to you soon.